In this video clip, we're going to look at the BCVR adjustments for the machinery. Looking at the question just to identify where we get that information. We know the BCVR entries is to it's adjustments that we make to record differences between fair value and carrying amount of assets, because from a group perspective the assets are acquired at fair value, but from the subsidiaries perspective it's recorded at the carrying amount. So in this case, our machinery in the subsidiaries accounts were recorded at $80,000 based on their accounting policy. For the group, it should be on 95, so we need an adjustment for the 15,000. Because the group carries that machinery at a higher value, it means that the depreciation that's flowing through from the subsidiaries accounts will be understated. So we have information about the machinery's further useful life, and based on that period we're going to record that extra depreciation charge. Just how the information then pulls throughout the question is in the acquisition analysis that fair value adjustment is made. This is of course at acquisition date, and we then identify that at that date a BCVR adjustment is needed for the fair value adjustment. What we now need to consider is on the date of the consolidation worksheet preparation, which is in this case now just 6 months later, whether that machinery still exists in the accounting records of the group, or whether it perhaps has been sold, or if it's later years fully depreciated, in which case it will have an effect on the BCVR entries that is included or not. But for this example, it's now in the same financial period as which the acquisition of the subsidiary occurred. So we see our standard BCVR entries for a depreciable asset. Now, this gives us an indication of what we need to consider for any depreciable asset that is revalued to fair value. And there's basically 3 categories of adjustments required. First of all, it's the valuation. So to adjust the value of the machinery from the carrying amount to the fair value, so that difference between the two values, the adjustment being required. The second set of adjustments relate to the extra depreciation that we need to record on group level. And thirdly, it will then relate to the reversal of the deferred tax liability that we initially created as that asset is consumed or used, which is of course reflected in our depreciation expense. And on the same basis, or over the same time, our deferred tax liability will be reversed. Now we know in this question that our machinery had to be adjusted with $15,000 to get it to fair value, because the accounting base of the asset has been altered. There's a difference between the accounting base and the tax base of the asset. Therefore, we record the deferred tax liability. The balance of that goes then to the business combination valuation reserve, which is similar in nature to an asset revaluation reserve when an asset is revalued in the accounting records of a company. But because this is now on group level only and not in the accounting records of the company, it's referred to as a BCVR or business combination valuation reserve. It's seen from a group perspective to form part of the equity of the subsidiary. Okay, the depreciation just covers in this question 6 months, because it's 6 months since the acquisition date of the subsidiary until the financial year end. The asset has a further useful life of 5 years. So over 5 years, we then record the extra depreciation expense that exists on group level. Throughout depreciation, we record the usage of the machinery. So over the same basis, we reverse our deferred tax liability that we've created. So 30% of the 1,500.